very short video. By short, I probably mean like 40 minutes. Um, and I think the title is going to be something along the lines of how to maximize your income and your earning potential and your earning years, that sort of thing, with a view being how to set up your portfolio, and essentially put yourself in a position where a lot of the work that you put in earlier in your career can sustain you for the rest of your life, basically. So we're going to look at different asset types, the advantages and disadvantages, or rather the strengths and weaknesses, that sort of thing. And then we're going to base that off of the model that I'm going to start with, which essentially is essentially a basic model of what you can expect with at least 2 or 3 of the asset types that I chose. All right. Without any further ado, I'm going to share my screen, and I'm essentially working with a hypothetical income slash business, right? So let me just put that there as slash income. But I prefer working with a business because essentially with a business that's scalable, and you can use leverage in the form of employees or other people, not necessarily leverage in the form of debt, right? Although debt is available to you, that's not the leverage that I'm referring to. Yeah. So I'm just gonna use that. I'm just gonna quickly open something else here that I'm gonna refer to for your guys' sake. All right. So essentially what you're looking at over here is a business with a revenue of 1.8 million, profit after tax or just before tax of 648,000. The reason I say before or after tax is because depending on how good your accountant is, you can actually end up reducing that in taxes. Well, obviously not necessarily just how good your accountant is, but the type of business that you're in. Essentially, that's a 36% return, right? That you'll be getting from the business. It is very high. So if it's an income, for example, that's a 36% savings ratio, and that's on your gross salary. So that is quite high. But I think just bear with me for the sake of the example. I easily could have gone a lot lower. I just chose these numbers because I've seen them before, and I think it's something that could work, right? So essentially from your profit, what I said was you'd retain half of it, half of the 648, and then the other half you'd put into a share portfolio. So we'd essentially be going from there to the share portfolio. And that's 324,000 Rand. And there I said the profit, essentially dividends, I calculated it at 8%. I do know some shares that can yield a return of 8%. So that's why I'm comfortable to use 8%. And then there it's the capital growth on the portfolio itself. I put it at 7%, right? I do have portfolios that I have seen portfolios that are growing at more than 7%. Again, it's just to be conservative. And essentially you end up with a return of 48,600, which you will reinvest. I'm not gonna deal with the reinvestment for today. Today I just want you to get that flow that you're essentially getting your income, revenue, you subtract your sales, your expenses, and then from your expenses you have your profit. And that's actually why I prefer to use a business. But as I said, I'm gonna use income just for example's sake, right? Yeah, I prefer a business because a business gets taxed after expenses, whereas a salary gets taxed before expenses, and then you spend what you have remaining, right? Alternatively, or as an addition, what I decided to do is to say the amount that you retain, let's actually assume that you take it and a bank is essentially willing to borrow you. So you use it as a deposit, right, for a property. and I worked conservatively or not, you can tell me in the comments, or you can call me if you have my number, that sort of thing, and actually challenge me on this. I'm not a property expert at all. And I essentially said, if you put a 20% deposit on a property, then the bank will borrow you the remaining 80. So every time you have a 1 rand here, we essentially can turn it into, let me do quick taxi maths, 0.2 into 5 rand, meaning that the bank is essentially borrowing you 1:5. So you can immediately see there that every time you have a profit, you then leverage that and get a property. That's actually when we touch on the pros and cons of each asset type. That's actually one of the benefits of property, the fact that you can put down a certain amount and then 5x it immediately in terms of property value. And that becomes important when it comes to when we deal with things like the profit or the return. Now you can imagine 81,000 Rand that you generate. So I said it's 5%, a 5% return. And then I said the property is growing at an average rate of 2%. Again, it was to where I get the assumptions. You can engage me in the comment section and I'll be free to share where they come from. But I think that's what would be reasonable amounts, right? To get 81,000 Rand income, having put down 324,000, 81,000 divided by 324,000, that is a 25% return on your equity. And that's one of the beautiful things about the leverage that you get from property. The fact that ideally, if you had put down your own money, 81,000 over 1,620,000 would have been a return of 5%. Well, I calculated it there, so dumb. But because of leverage, because you're using the bank's money, essentially that 5x's it, and that's a 25% return. Now, very important thing to note here, right? The reason why I want you to put a deposit, even if the bank is willing to fund you 100%, is because it's very rare where you're going to get rentals that are going to cover your bond amount. And it's very important when you're doing this sort of thing, when you're going into property, that as a start, you get properties that are positive cash flowing, even if it's 1 rand, even if it's 100 rand. It's better than the situations where you say to yourself that I'll be paying in an extra 1,000 rand or 2,000 rand into my bond. Doesn't make sense for me. And then there are other, what do you call it? Expenses that you can claim from the property, depreciation, amortization, non-cash type expenses that increase or let you keep more of the cash flow and give you tax benefits over and above the 81,000 Rand that you would have made. So essentially that would be the flow. So you make your income and then the huge profit that you make, 36%, you take 50% of it, you put it on the JSE into shares, you take the other 50% and you leverage it and get property. And over time, that is how you build a diversified portfolio away from your income, right? And so what I did with this example is I let it run essentially for, for 10 years, just so that I can show you what the numbers look like. Just give me a second. So I'm gonna unhide these columns. And so you'll see some of the assumptions that I used is that from year one, these years, so I identified two stages of your retiring rich, call it that journey, right? The first 5 years is you continuing to earn and maximize your income earning ability. And I kept the ratio consistent in terms of the profit. And then in terms of the amount retained, 50% always of the profit would be going to equities. And then, yeah, the other 50% you'd be leveraging to buy properties. Then the remaining 3 years, I used 8 years in this regard. I had someone actually ask me, is it possible I'm 32, I want to retire at 40? Is it possible to do so? So what I did was I said after 5 years, they're essentially going to slow down a lot more. Essentially, you're going into that phase of seeing, can the business continue to run without me? It's very easy when you're hands-on to grow the business at 20% per year, right? But when you a lot more hands-off, I went for a conservative 6%. Obviously, that's a drastic slowdown, but I felt it's reasonable just in terms of allowing your business to grow at an inflation rate. So you're letting the systems run by themselves. And then in terms of the profit margin, I dropped it from 36% to 20%, which is still quite high, but it's still, I think it's a lot more reasonable for someone that's hands off. And then essentially over the 8 year period, not 10 year period, over the 8 year period, I just did a sum that calculates how much revenue you would have generated over the 8 years, and then how much profits you would have accumulated over the 8 years, giving you a total amount. And then let me just see. Yeah. And then we take these half, so this half of this essentially goes into shares, and then the other half goes into property. And then we're just going to have a look how much your portfolio ends up being, right? So I'm just going to change that from C to D8 to M8, right? And then the next one here will go from D10 to M10. And again, the idea is that the 4 million rands that you've made over the 8 years, essentially you've continued to leverage that and get a property. And what you see on this side now is that you have a situation where you have a 5 million rand, 4.7 million rand share portfolio, which at 8% in dividends is yielding about 378,000 rand per year. And then in capital growth of 7%, it's yielding about 331,000 rand, giving you a total return of 709,000 rand per year. And then with the property portfolio, you essentially would have almost 20 million rand, so 19 million rand in properties, generating rentals of almost a million, so 955,000. And then capital growth at 2% of 382,000, giving you a total return of about 133,000. And then if you add the two together, so what I did here, I added the property values as well as the share value, and I divided it by T7. You'll see on here, I added the two, and then I got the value of the properties and the shares, and then I essentially multiplied it by 0.11, which is the average return between what I'm getting from property and shares, right? So again, you'll see I work with conservative numbers, and the reason I work with conservative numbers is because depending on how ambitious you are from this point, you then can rake those numbers up quite extensively. So I'll show you now, for example, if you're an employee and you're working with much smaller numbers, let's say a million, what your ultimate number looks like. But I wanted you to get that relationship to say you're essentially making an income, spending, and then what's left, 50% to shares, 50% to properties. Obviously, when you discuss this with your financial advisor, you can, you can decide on a bigger split or a much more differently weighted split, and you'll consider some of the factors that I'm going to put forward for you. Then what I have here is that I essentially said if you sell your business in year 8, at the end of year 8, you can sell it for up to, so you'd have generated 33 million rands in revenues, and then with a profit of 10 million or 9.5 million. I therefore then said that you selling it essentially, if I say 56.826 divided by 9.457, right? At a PE of 6, right? So you're leaving on the table an earnings yield still of about 16% for the person buying the business. And 16% happens to be just above what they would be getting in shares. So it makes sense why your business is lucrative to sell for that 56 million. And it's generating 11%. The money that you would have made from the business, the sale of the business, invested in one of these two assets, depending on the ratios that you choose, I then gave you an average return of 11%, which then means that you essentially would be getting a return of 6,250,000 rand per year. And again, depending on how good your finance team is, depending on the expenses that you've got, the structures, the vehicles that you own, that can essentially end up being tax-free. In the event that it's not tax-free, I think you can do the maths and see what that looks like. So at least here we have a realistic view of how after 8 years, you can essentially be in the region of 6 to 10 million rands or 5 to 10 million rands. And yeah, we're still gonna work with these numbers even more so that you see what we do if it grows at a faster, slower rate. And I've highlighted them luckily so you can be able to see where what is going, as well as be able to see the effect of little changes on this side, right? So if I'm just gonna come back here, oh, the year 9 here that I created, year 9 was just to say this is after you've left the business. If you decide not to sell it, then what do you have in terms of income, but you are away from the business? And I still kept it at 20% and 50-50. So you're essentially looking at an income of about 1 million rands from the business itself. So let me say it's that 1 million rands plus what you get from your share portfolio plus what you get from your property portfolio. So you're looking at about 3 million rands in annual income if you decide to continue to keep the business. If you sell the business, and assuming you sell it at a PE of 6 and all of those multiples, you essentially can end up with an asset, an entire portfolio of about 56 million, generating 6.25 for you. So those are the numbers, right? If I come here and I change this to 1 million, so this is more the income type vibe, right? You have 1 million coming in and you have 36% of it being profits, meaning that you've spent 64% of it, so be it in taxes as well as living expenses. And then out of that 360%, every year you're putting 50% of it in the stock market. For a good 5 years, you're growing it at 5%. So meaning that you make it essentially to like executive level. I don't think you can grow that quickly to executive, but as I said, I was working with business numbers initially, and I just want to get you a more or less good approximation of what it can look like, what you can do on a salary of 2.4 million, for example, after 5 years, which you expect to then get inflation type increases, it getting up to 3 million. You essentially, after 8 years, would have earned 18 million. And this is what the numbers then look like if you take half of that and put in a share portfolio, and you take half of that and you pay it as a deposit on a property. So you end up with a share portfolio of about 2.6 million and a 10 million rand / 11 million rand property portfolio. And what's interesting for me with that property value is that it's not uncommon that you find that that's maybe half of that. That's what you would find an executive living in at that point in their career. And it's not to throw shots at them, but it's to say essentially that's what you could have been investing in a property for portfolio, generating about a 7% return, which is about 743,000 Rand. And so you're essentially getting about 1.1, yeah, 1.1 million rands on the side passively, and then your income as well, right? What you get to keep from your income. So that was just with a million rands, what you can end up with if you start with a million rands. And then for second last illustrative purposes, I'm just gonna work with, let's say 500,000 Rand. So if you earning 500,000 Rand and essentially keeping 180,000 Rand, I think it gets a lot more difficult at those levels. I just want to make sure what is it in at a monthly divide by 12. So it's a 41K salary, and then you say 36% of that. By 36%. Okay, there you go, 15,000 Rand in profits, or 15,000 rands in disposable income, and then you essentially do all of this, right? It's always interesting to hear people say you must be disciplined, you must save. If you didn't spend the amount you did on a car, on a house, on this. Look, I don't do personal finance, so I wouldn't be the one to advise you what standard of life to be living. I just work with assets and investments. If you give me this much, this is what I can do. If you give me that much, this is what I can do. But essentially, you'd have about a 1.3 million rand portfolio with about a 5.3 million rand property at the end of year 8, when your salary is about 1.4 million or so, having earned 9 million in the last 8 years, saved 2.6 million, of which that in that 2.6 million, half is on the JSE, and the other half you use to leverage 5x to buy properties that yield you the income as indicated there. So you can actually get quite comfortable passive income. So it's about 568,000, having started with a salary of 500,000 Rand over the next 8 years. I think what I just want to do is just ramp up just for the last bit. If I change this revenue number, we had started with 1.8 million, right, with our business. And just for our business owner, if I say your starting point, so at the end of this year or within this year, if you start at, let's say, 2.5 million, which is essentially about 50% growth in your business, slightly less in the following year, you then and keep the same ratios, so the same profit ratio, and then the same investing ratios, and then you start growing this by 20% every year, you essentially can end up in a situation where you have about a 6.5 million rand share portfolio with a 26 million rand property portfolio. And if we look at your passive income, you're looking at 3 million rands, close to 3 million rands. Plus, if you don't sell the property, if you don't sell the business in year 9, you're getting 1.5 from the business, a million from your share portfolio, and about 2 million from your property portfolio, which gives you an income of about 4.4 million. If you sell the business, again, those similar multiples, you then are looking at an income of about 8.681 million at 11% for that property portfolio. So it gets quite close without even stretching yourself too much. So by growing your business from a 1.8 million rand business revenue to a 2.5 million rand business revenue in the next year, and then growing it by 20% each year for the next 5 years. And then after that, it grows by inflation. Just interestingly, so I had grown it by 6%. Let's grow it by 10% here. So this is after you've resigned from your business. It's growing by 10%. This is just to show you what the numbers can end up looking like, right? So again, you're looking at about 9 million rands now. And then from these two, you're looking at comfortably 3 million. And then if you add the other 1.7 million, you're looking at again still 4.6 million, right? So that's what the numbers look like. I'm just going to detract these columns again, just so that we can have everything next to itself, so that when I speak to it, you can see them on one screen without having to strain your eyes or anything like that, right? So here's your business. I've then said this is after the 8 years. And then if you decide in year 9 to keep the business, that's the passive income, what have you. So that's what the numbers look like. And then what I'm just going to do is delete those columns so that they're not distracting me. That's a no-fill. I'm going to remove those two. And these are the factors that we're going to look at. I got these factors a couple of years ago at one of the JSC events that I was attending, and I thought, oh, it's a phenomenal concept to teach asset types, right? Perhaps let me paste it here. Just bear with me. I'm just going to download it. Copy. I'm not even gonna know if it's showing on what do you call this? But it should show if I paste it on Excel. Let's have a look. There we go. It's called Understanding Asset Types. And then essentially what you're looking at is that. And what that's supposed to show you is how we consider different asset types. And I'm just going to quickly talk through each of the criteria, but also using our assets that we have here. So I'm just going to write here criteria, then control V there. So the first one is income, right? And as you can see there, business has the best leverage when it comes to income. You see everything else there, nothing is red. I mean, it's green. And that's why I said it's very important from the get-go to make sure that you're generating good revenue. That 500,000 that we played with, if you're a salaried employee, getting it to 1 million, then 1.8 million for the business owner, and then getting that up to 2.5 million. And let's even get that to 3 million. 3 million. Do you see how the numbers just keep populating? Oh, that's 30 million, dear Lord. We can get there. I've seen clients that bring in revenue of 15 million rand. So that's quite impressive, right? That's what the numbers look like at 3 million. You're hitting your 10.11 million essentially. So at 3 million, you kind of can see that's the figure that you probably would be looking at if you're looking at generating 10 million. Let me see if we say 2.7 million. It's not too far off, eh? 2.7 million, yes. Yeah, somewhere between 2.7 and 3 million from next year, and then grow it at 20%, and then again at 10 or 6%, right? So that's income. We can see then that business has got the better income prospect. I like to think that shares have got, but many people will fight with me. So I'll keep it neutral. As you see on the graph here, it says neutral, right? Meaning that the income prospects of shares is, yeah, it's neither here nor there. It's okay, it's neutral. And then the same with rental property, right? Obviously, I'm not too happy with that. I'm a dividend investor, but I don't design the graphs. Then the next one, the next criteria is taxation, right? Taxation, they have business at neutral. I would have had business at green because I'm an accountant myself, so I know how well you can use the tax laws in your business to get yourself favorable what's this favorable returns or favorable outcomes from your business. But I'll keep that for now, right? Share portfolio is neutral as well. That's because dividends are exempt on local companies, especially if you hold your share portfolio in a company. And then taxes, when it comes to rental property, it's also neutral. Again, property, the same as with the business, you actually can run your property under a PTY LTD, and that gives you a lot of tax benefits that you're able to use. So I'll keep the neutral rating. So far business is ahead, but luckily that's our main source of income, and we're using it to diversify into the other income streams while we work hard, ramp up the hard work, and then later on land the plane. The next one we're going to look at is liquidity. Now, liquidity speaks to how quickly can you turn this into cash. And there, for the first time, we see business, it's red. That implies that it's not so easy to sell a business. Chances are it's because it's very specialized. You happen to be very nuanced, have certain nuanced knowledge in it. And so it becomes a slightly more difficult to sell a business. I'm going to make shares dark green. And that's because shares predominantly sell on a daily basis. So at any given point in time, you can look at the value of your portfolio and press sell on your portfolio, and the markets are live, and then somebody would be willing to buy your shares. And as you can see there, it's got two pluses there, meaning that it's extra. Unlike with the business, the income was 1+, hence it's the lighter shade of green there. And then we go to the property. Property is red, so it's a minus when it comes to liquidity. I think there, depending on your level of nuance, I think you would know how difficult it is to sell a property. I've heard that properties barely sit on the market for less than 6 months. Then we're going to look at flexibility, right? Flexibility essentially talks to, and I'm careful to not confuse it with divisibility. Flexibility maybe speaks more towards what are the number of things that you can do with it, right? And again, I'm sure I'm not explaining it well. Maybe when I speak to divisibility, I'll be a lot clearer. But flexibility, essentially, how flexible are you able to be when you've got this asset type? With a business, for as long as you're the owner, you kind of have to be there, build the systems, you have to put in the hard yards. It's very difficult for you to move around and kind of not be there for your business. Share portfolio, look, you buy the shares and then it trades forever on its own, and you never even have to be there in person. I prefer to attend AGMs, and that's because I love speaking to other CEOs. I love talking to other chairmen. I love engaging with people about the nuances of their businesses. I love business models. So that's why you would find that the flexibilities, but if I'm not there, they continue to pay my dividends and the share continues to increase or decrease. I don't particularly have to be hands-on. Flexibility with property is also quite diminished. You'll see the distinguish here between primary residence and rental property. Your primary residence would most likely be even worse, but your rental property would be slightly better. But either way, it's very rare that you run a property portfolio completely hands off, especially in the beginning when you're still ranking up to that level where you're a fully fledged property company, right? Then when we go to divisibility, for me, divisibility is my favorite one. And essentially, this just speaks to, I always make the joke that if you want cash, but you don't want to sell your whole, you don't want to exit your whole position. And with property, I always say, you can't sell the garage in order to go and use the money to buy something else, to go on holiday or whatever. But with shares, you can say, if I've got 1 million shares, I'm gonna sell 50,000, go on holiday, and then come back and we'll work it back. So it goes without saying that it's not very divisible, right? With a I spoke to property there, so I'll put property red. And then with a business, it's a lot more divisible than property because you can bring in other equity partners. Um, you can you can do a whole lot of arrangements. You can borrow money from the bank using certain assets as collateral and not the whole business, that sort of thing. So it becomes easier to monetize and enjoy that divisibility factor. When it comes to equities, again, as I said, I can sell 1 share, I can sell 1,000 shares, I can sell 100,000 shares. The divisibility is not really a problem there. Then this is where property wins, and this is why I spoke to that factor of a bank being able to borrow you on your property to the tune of 5x, right? Geared returns, right? With a business, it's slightly more difficult to borrow from a business, but they still ultimately would borrow. I see it's got two, what do you call it? Two pluses essentially. I think it's slightly more difficult than with property, but there you have it, right? And then with a share portfolio, they have it red. I would have preferred they have it neutral. And that's because you actually do get products in the market that are willing to say, evaluate the quality of your property, of your share portfolio. For example, if you've got 7 million rands worth of shares, there are financial institutions that actually are willing to say, borrow us 3 million worth of those shares, or we can use 3 million as collateral. They're comfortable that that's the amount of fair value that they can rely on. You also have situations where people that are shorting stocks can actually lend your stock from you, sell it, and then pay you interest while you're not essentially enjoying the rights of ownership of a stock. And then they just have to give you your shares back at a later date. Normally, they give them back when the share price has plummeted because it's cheaper for them to then buy the shares back, and then they keep the profit. You don't care because you'd have gotten that premium income. But alas, that's not available to everyone. So geared return is a red for equities, but it's a double green for both the business and for property. Then from there, we go to bulkiness. Bulkiness just says, yeah, if you own properties, it's there, it's huge, right? For a business, it's neutral. You can run a fairly profitable business that doesn't jump so that, hey, these guys are actually printing money here, right? Um, Share portfolio does not have any bulk to it, but it's not a double green. That's not one of the biggest advantages of it. And it goes without saying that a property you can't put in your pocket and go on holiday, right? Then we go to control. Control speaks to essentially how much can you affect your outcome, or how much can you change the variability of returns, right? With shares, you pretty much buy, and then from there, depending on how well you bought, you're just at the mercy of the company and mercy of the management in terms of dividends and in terms of the market's reaction. So that's why under control, oh, yes, it's still green. I think it's because that buying power is still a very an important one. I can decide which share I buy and which share I don't buy. That gets me in, and then both property and business are green. That's because there you can 100%. You can decide to add a swimming pool. You can decide to hire fire people. and you basically have control over your returns. With shares, as I said, I think it's limited, but you can still sell, you can still get your dividends, that sort of thing. And you can control the price at which you get in and exit stocks. So you're not stuck inside. So that somewhat controls your return. I don't think it's the best example of it, but they have it as green. And I think I'll put it there. Then costs, how much it costs to enter um, these asset fields. Business, and I've heard people say you can start a business with as little as 10 Rand or you don't need any money. I'm yet to meet people that start businesses without any money. From what I've seen, yeah, you feel that you've got skin in the game. And then rental property, it's a capital game. Everybody knows that for you to be in property, you essentially have to have stacks and stacks of capital. We then go to our last criteria, which is risk. Risk basically speaks to what are the chances that you can lose this thing, right? With a business, I think it's every single day. You know, if you're an entrepreneur, they tell you if you're not selling, you're dying. Cash is king. If you're not making cash, you're dying as well. So a business is red. And then a share portfolio, they have it as red as well. I think that's because of the volatility of the markets, that sort of thing. I don't fully agree because there's a lot you can control with shares, but it's clear for you guys now where my loyalties lie. So I'm not going to harbor the point home. Um, and then with property, it's also red in terms of risk. And I know there are people that are saying, property is risky. Why? Wara, wara. And that's because it actually is competing with inflation. I mean, if you see, I have a return of 7% here. So in essence, it's actually very difficult for you to be able to generate a high return on property above inflation. The place where you would be generating that return from is you would be getting this 1.4 million rand rental income, having invested 5 million rands. So that becomes what, 14%? I think we had calculated it. Oh no, it's seven, it's times 25. So let me just do the calculation if I've gotten this far. 5.1 divided by 5.804. Yeah, 25% return. And that's because of that leverage factor. But the minute you take on leverage, you understand that you've just decreased your riskiness because now you have to pay back the bank the 29 million rands. So depending on your risk appetite, that actually can become very uncomfortable. And actually, that's why some of you would have seen that I'm not the biggest proponent of property. And it's because most people that own property are essentially looking to pay it off immediately. But that's one of the biggest advantages of property, those geared returns that you get from it, as well as the tax advantages, I would think. And yeah, outside of that, you essentially are wasting capital or you're too conservative for the asset type that you've taken on. That basically gives you a number of factors that you can use with your financial advisor to basically decide how to diversify away from your primary income. And as you can see, even those stocks are a clear winner in terms of the greens that they've got, right? I still would use property because number one of that leveraging factor, but number two, it does have that diversification factor of when markets are low. So with inflation, I didn't even touch on with inflation, but there's relationships that they have when interest rates go up, then inflation either goes down or should go down. When inflation goes up and interest rates go down, you end up with a huge asset that you're able to leverage up and down. So if we count the greens, you'll see that in third place out of three, we've essentially got property. In second place with uh, four greens, four, one, two plus two there, yes. So it's four. You have business, but I would never eliminate business because that's the start of this thing. Business or your income, you know, people who hate on a job, your job funds your retirement, your business funds, your retirement. So that kind of wasn't competing. And clearly the outright winner with 9 greens is shares. But I also wouldn't advise you put all of your money in shares. You consult your financial advisor and then you have a look. In terms of the rest of this table here, what you will see is that a lot of the rest of these items are derivatives of what we've spoken about. So unit trusts would fall in the same category as shares. That's why you'd find that they'd have the same greens and the same reds and yellows, except for control. Unit trusts don't give you control of what shares you can own. You kind of just buy and then you sit on it. Then tax-free savings, they say income is a negative. That's because a lot of companies that qualify to be in ETFs, exchange traded funds, they don't necessarily give you good returns. And then in terms of liquidity as well, tax-free savings is a locked-in vehicle. I do like it for that factor, but it counts as a negative for liquidity. And then everything else is similar. Flexibility and control are also understandably very low. Then retirement savings are also a derivative of shares. But what's interesting with the retirement savings, the biggest benefit with them is the tax return, right? But in terms of income, they're not going to give you income until the end. Liquidity, you can't really do anything or move anywhere. And the geared returns, you can't really borrow to buy them. And then control is absolutely none. You're basically at the mercy as you have your pension fund holders. Residential property, my favorite. Everybody wants to buy a house. Income, nothing. Liquidity, none. Flexibility, divisibility, none. Geared returns, it's actually neutral. And that's because for the large part, you're essentially just borrowing to buy a house. And then they'll give you a slightly lower interest rate, but the geared returns are nothing compared to what you're doing with rental property. And then, of course, it's bulky. You've got control over it. You can, as people like to say, you can drill a hole in the wall and nobody will tell you anything. And then the risk is neutral. That's because it's probably growing at inflation and nothing more. If you like share portfolio, we've looked at, and BEE shares. BEE shares, the important thing to note is that they mitigate for that geared returns aspect. And that's because a lot of BEE deals involved vendor funding. And that is the situation where you have, what's this? You have the issuing company funding the BEE vehicle on your behalf and essentially allowing you then to own the share after the dividends have paid back their funding over the course of the life of that vehicle. And the other item under control is neutral. That's normally because BEE shares, it's certain shares that would have BEE structures, but also, as I said, you're not collecting the dividend, and they normally would have a lock-in period. So you must hold the shares for 5 to 10 years before you're allowed to sell them. And then the risk is still the same because, as some of you will know, that they also sometimes do tend to have certain conditions, like the share price must be positive from date of purchase for you to be able to get the share completely. And that speaks to the entire exercise of portfolio management and what it looks like. I think the most important thing for me was to see that you don't have to live on your income and then hope that you'll be fine. During your working life, you actually can diversify it away, personally, preferably into shares. But for most of you, it obviously will be into property. Please do so responsibly, do so with the advice and assistance of your financial advisor. But you actually do see that you actually can get away with investing your income and your surplus business income, your profits, away from your business. If you felt as if my assumptions were a bit too generous, i.e., 36% net profit ratio or 36% disposable income, in the sense in the case of salary, please do let me know in the comments. I can adjust these to be much lower, so 20%, you name it. But the important thing for me was that you get to see the numbers as they are. And also, I wanted to work off a case that I found very interesting with one of my clients. where essentially I had seen that they were making, I think, 640 or something like that, um, as a profit. And with good tax management, they're able to make that disappear. And essentially, they were able to retain that and be able to invest that in shares and property and be able to see if they continue to do this for the next 8 years, working hard, working diligently, what is it that they would be able to achieve. I think what would even be interesting would be what would happen if I change this number from zero point 0.5 to 0.75, which is 70% in shares. And then, okay, that stays 20%. Yeah, so it's a long calculation. But essentially, it's that I'm essentially still getting 8% on that higher amount. But on 1.8 million, already you can see we're dealing with a million versus when it was at zero point 0.5, we're dealing with about 700,000. Look, I enjoy playing with this thing. Yeah, that's me, Chairman Mo. That's your income optimization and portfolio diversification tool. Shapo. It's the same story with every video, eh? I can't find the stop recording